Joining us now to discuss the future of rates is Bob Michele. He is Chief Investment Officer and head of the Global Fixed Income, Currency and Commodities Group at J.P. Morgan Asset Management. Bob, good to see you.
Happy to be here.
How much of a jolt to market expectations and pricing and the expected tone was Warsh's remarks yesterday?
We think it was quite a jolt. The first jolt, first of all, was the very hawkish tilt, the focus on inflation. Suddenly, we went to 9 Fed officials that were looking for a rate hike this year from 0 just 6 weeks ago. The market was a little caught off guard on that. The inflation expectations, when you look at PCE and core personal consumption expenditures, went up anywhere from 0.6 to 0.9%. So that was pretty hawkish. And then, of course, when we got to the press conference, Chair Warsh made it clear that he was tearing up the script, which he's entitled to do. He can revisit the operating framework of the Federal Reserve, but to do everything in one day caught the market a little bit by surprise.
Yeah, I thought that it sort of bought him time, though. I mean, in terms of making any sort of monetary adjustments by saying we've got a task force for that, we've got a task force for that, and then we're not going to press on anything until they come up with their findings, and that'll be the end of the year. He's delayed that sort of any major decision on monetary adjustment until the end of the year. So the markets have this. We know we have this framework right now that had existed at the Fed before.
Well, when you think about an institution that's been around for 113 years, 6 months to go through these 5 major work streams and come up with recommendations and change it actually isn't quite as long as it seems. But look, he's entitled to do it. We think he's focusing on the right things. The Fed's incredible hands.
Warsh really wants to go back to an earlier version of Fed communication, it seems. He's got a task force, but clearly is not comfortable with forward guidance, with a lot of explicit detailing of the outlook. Is the market going to have a major adjustment to that?
It will. I'm not for it. I don't understand why rolling back transparency is either good for market participants or for the Federal Reserve in terms of trying to manage the volatility and backstop the banking system and achieve their mission. So I don't quite understand that. I'm anxious to see what comes out of the task force on communications, whether the rest of the market is behind it. For sure, if you have less transparency from the Fed, you're going to have more guesswork and anxiety in the market. It's going to create more volatility. I should probably like that. As an active manager, you'll have more opportunity. But I step back and I think about the markets and the economy. I don't think it's helpful.
He doesn't like forward guidance, and yet over and over again he said the Fed's mandate is price stability. They will deliver on price stability. Inflation is a choice. I mean, these are all phrases that imply that they are actively looking at some sort, looking at monetary policy and possibly leaning towards that hike. Do you think every meeting is live at this point? I mean, do you think that is, coming soon? Has that been pulled forward?
Yeah, absolutely. Every meeting is live right now.
Even the one in 6 weeks.
Yeah, even the one in 6 weeks. You're pretty much right on 9 people. I would say there are 10 people. I would put him with the other 9 that are looking for either rates to stay where they are or somebody had a cut for this year. But we'll see what the data comes out like over the next couple weeks. The inflation data's not likely to improve until you get further into the summer. It's quite possible inflation will peak in May. We're not going to see that for a while. We won't know that for a while. When you look at the other central banks out there, they're being vigilant. They're tightening rates, 1 or 2 rate hikes in here. It's not going to break anything, but it reassures the market they've got an eye on inflation.
What are the main investment implications of all this across the various parts of fixed income?
Well, when we look at the bond market, you have to appreciate the bond market had already repriced. The 10-year's not at 3.90 where it was at the end of February. It's also not at 4 5/8 where it was last month. It's just under 4.5%. We think that the bond market's in a trading range now, somewhere call it 420, 430 on the low end to call it 4 5/8 on the upper end. We're right in the middle of that. When we look at the Fed futures curve, the market had already priced in 1 rate hike over year end before the FOMC meeting. So you might say the FOMC caught up to the bond market. The bond market to us looks pretty stable. It's got a lot of yield in it. There are tailwinds to the economy, so corporate credit looks fine. It's an inviting place to invest.